Welcome to the 20th Montgomery Summit. You're watching Monty TV. I'm Jackie Karsh, sitting down now with Michael Brown. He's a partner at Fenwick & West. Michael, thank you so much for sitting down with me.
Thanks for having me. Excited to be here for the 20th anniversary.
Honing in on some of the buzzing topics of the day, generative AI and all the machine learning that we've been exposed to in the last few months that have really generated a lot of public interest. But is the liquidity not there anymore?
Yeah, it's hard right now. So certainly for fundraising for companies, I would call it a tale of two. So for early stage companies kind of Series A, seed, pre-seed, those companies are certainly still able to raise funding. And a lot of the venture capital investors that I talk to say we're open for business and we want to invest into new deals. And so earlier stage companies where smaller dollar investment amounts and lower valuations, those companies, good founders, good ideas, initial traction, those companies are able to raise capital. Companies later stages, Series C and later, those are companies that I think are having a little more of a tough time, in large part because they probably raised around a year, 18 months, 2 years ago, where they raised significant dollars at a significant valuation that may be unsustainable by the current metrics and multiples. If you're a company at that stage, you probably have some type of a public company comp. So you have the investors looking at the public company comp, which is probably trading at a much lower multiple than what it was previously. So those companies are finding it hard to fundraise. It's not impossible. Certainly a lot of companies that later stage are able to find fundraising, but you might have to take structure. You might have to give warrants. You might have to recapitalize the company and wash out some of your early investors. So there is a lot of uncertainty right now, especially for the later stage companies, on where will the next round of fundraising come from.
Certainly those early stage companies, they're not affected as much when valuations change. But those later stage, how are you advising those clients when what they thought they had is not as valuable as it is anymore?
It can be a tough conversation. I tend, and I think directors sitting around the table, inside investors, tend to say, look, if you look at your comparables in the public markets, look at where they are from 12 months ago, and certainly their valuation has gone down significantly. And so while historically private valuations have been more immune to the vagaries of the macroeconomic system, I think you have to look at it in totality of, all these other companies, they're facing the same situation. So it's about living to fight another day is the conversation I have, which is you might have to fundraise now and it might be at a down valuation and nobody likes that. But if it gives you enough capital to get to that next inflection point, to get the company to a place where it needs to be to survive and be successful over the long term, then that's the right approach. And taking your medicine now that gets the company right-sized, that can be a long-term successful outcome and strategy.
Michael Brown with the Reality Check. Thank you so much for sitting down with me.
Thank you for having me.